Good morning, everybody, and thanks for joining this webinar this morning. Obviously, some quite tricky times out there, and some very sad times as well with what's going on in Europe. We've experienced a huge amount of questions in the last week or two from organisations of all shapes and sizes, really, that are facing potential impacts from what's happening in Ukraine and Europe. And so we thought it would be appropriate for us to run a short webinar this morning for those that wanted a bit more information, spontaneous information on the current events. So thanks for joining. For those that don't know the three of us, or Optimised, as well as some of our clients who I know are on the call, Optimised is a UK-focused energy consultancy. Energy and sustainability. In fact, we look after around about 300 organisations across the UK, over 5,000 assets, and all aspects of their energy, costs, consumption, sustainability, etc. The trading and risk management function specifically is a team of people that sits in our headquarters in Blackpool. Surrounded by all of the market information and the live updates that you would expect from any trading desk that's focusing on managing commodities for organizations, and that's really what they do over the long term. This is not just something they're doing currently, given the volatility. This is something that they do day in, day out. And as I said, the reason for running this webinar today is really due to the volatility and the extreme events that we've experienced in commodity markets in the UK over the last 2 weeks, but more than that, in fact, over the last 3 or 4 months, where we've seen these events really starting to ramp up. So before I hand over to Dave and Magnus, if anybody has got questions, there should be a little box, a dialog box within the webinar screen. I'm hoping that that's active. If you could use that, put any questions in there. We'll look to finish the webinar piece within about 30 to 40 minutes. And then if there's any questions, we'd be happy to take them at the end. So just a quick intro on Dave and Magnus. Dave runs our trading and risk team. He's been leading that team for the last 4 years. Previous experience from supplier background, so as part of the risk function within TGP, now Total Energies, and he's responsible for doing a lot of the trading for our clients. Magnus has overseen procurement and trading teams at various organizations in the past. That goes from suppliers to National Grid to buying energy for the government at various times. So he's been there and seen this, not this before, because nobody's seen this before, but he's seen everything that has happened in energy markets over the last couple of decades. So you've got a lot of experience in the room, and please make use of that later on with the questions. So without further ado, I'll hand over to Dave to get us into the subject.
Perfect, thanks for that, James. So we've sort of pulled together a quick agenda on what we're going to cover today, namely around gas and electricity prices, what's happened over the past year and where we are today, what sort of levels of prices are we facing. Just a quick breakdown on the UK and EU sort of portfolio makeup and where they source their gas and electricity. What does the current fundamental picture look like in terms of supply and demand levels? What are the UK and Europe doing in response to the Russian invasion, and particularly all of the sanctions that are going on at the minute, how we're going to move away from that kind of Russian gas dependency. How will this impact my bills? It'll give us a quick high-level view on the kind of costs you should be expecting to see over the coming years. And then what clients can do to minimize the impact of these price rises that they're expected to see. And then finally, what about my supplier? There's been a lot of questions recently about security of supply with their supplier, and what we should expect to see there as well. So if we just start off with a kind of long-term view of price movements, and you can see here a 10-year graph. This is looking at the front seasonal price development over that time. The main thing to pull from this is that we can see for the first sort of 9 years of this, we had a relatively stable price curve. There was not too much volatility, or at the time it seemed like a lot of volatility, but when you look back in hindsight, it was relatively steady and it was relatively range bound. You had periods where the market would drop off slightly, in periods where we had excess supply or lower demand, namely in 2020 when you had the COVID pandemic. The demand destruction there meant prices fell off quite considerably, but all in all, it's been relatively range bound. When you come into 2021, it's very much a different picture, and we start seeing the start of that exponential curve. When we move into 2022, you can see at the far end of the graph there the current kind of price crisis that we are seeing in energy markets at the minute. So if we just take a look firstly at the front seasonal prices, this is looking at summer 22 contracts for power and gas. Now, I'll just give a quick recap on 2021 and how we saw price movements. That's when we started seeing the increase. So if you look back to sort of March, April time, and you can see on the far left-hand side of this graph, prices look relatively low, but at the time that was sitting relatively high compared to previous years. Now, we had a bit of a late cold spell in sort of March, April period last year, which just increased that demand within the UK and within Europe as well. A lot of what we'll talk about here is probably UK specific, but we have a very similar impact in Europe as well. So that colder temperatures and that increase in demand just started the issue here. Now that was reflected over in Asia as well. Northeast Asia, so China and Japan, also felt a bit of a cold spell, and as such they started the sort of increase of demand for LNG, which is liquefied natural gas, which moves worldwide. So that was the first part of the problem. A lot of that LNG started moving over to the Northeast Asian market and started starving us over in the UK. So we had a bit of a limited supply of gas at that point already. It also meant that we were digging into our storage levels across Europe, withdrawing from those storage levels and just depleting those a little bit further. Usually when you're in the April period, you start injecting into storage levels, topping them up ahead of the winter period. But at this point in time last year, we were just depleting those a little bit further. And then finally, throughout that period, particularly the summer period, we had a lot of ongoing maintenance around European gas fields, which was delayed from 2020 off the back of coronavirus. So that was just the start of a limited gas supply into Europe, in and around Europe, sorry. And then the lack of sort of storage that we could put in there ahead of winter. So you can see the kind of price movements we saw throughout the summer period started this exponential curve on the lead up to winter. When you get into that final couple of months ahead of the winter period, so ahead of October, you start seeing the increase in the rate at which prices are increasing. Now, markets tend to do this on the lead up to the seasonal contract, purely on the basis that they're trying to anticipate what's going to happen during the winter period. Forecasts over that time were that temperatures were going to be extremely cold. We're expecting a La Nina weather phenomenon to come across and drop some cold temperatures on Europe. And the concern was that there wasn't going to be enough gas to get us through the winter period. Now, you can see a slight spike here as well around this October 21. That's when the majority of the sort of risk and concern came to a bit of a peak. Doesn't look too large there, but at the time that was sort of reaching all-time highs. Since then, throughout the latter half of sort of Q4 2021, the market remained relatively volatile, but range bound. And you can see that there was no sort of underlying trend. It was staying fairly flat. And that was just awaiting a little bit of direction to understand whether we would have enough gas in the system and whether it was actually going to be as cold as expected. It actually turned out to be a relatively mild period through October and November. The story changed very much when we got into December. Temperature forecasts were revised lower. A lot of the LNG schedules that we were expecting to come across ended up being diverted over to Northeast Asia. And again, we were starting to be starved of that gas. We also started sort of depleting our gas storage levels even further. And the concern was when we get into Q1 of 2022, which is typically the colder half of winter, that if we get a further cold spell, we might not have enough gas to get us through the rest of winter. So that's why you saw this sort of exponential rise, particularly on the lead up to Christmas, and that final week before Christmas, we saw markets peak at a very, very high rate. We saw markets increase at very rapid rates indeed. Coming back post-Christmas, and the story was very different. The fundamental picture changed very rapidly. Temperatures were expected to be extremely mild, and we had the mildest New Year's Day on record. And as a result as well, the LNG market and the competition there, we managed to source a lot more LNG over to the European and UK markets, which again just eased that gas supply concern. So the markets retracted quite considerably. And then we entered another period of, again, range-bound but volatile with no underlying trend. The market was awaiting direction. Obviously, we were having the geopolitical tension with Russia and Ukraine starting to be sourced, but there was no sort of clear direction as to what would happen there. As soon as Russia decided to invade Ukraine, you can see the impact that the market had. Now, as we'll go into in a little bit, this isn't really based on actual fundamentals, actual supply and demand levels. This is very much a lot of price risk that's built into the market and almost speculation over the what if scenarios of what could happen. So the market almost went into a bit of a frenzy mode, and you can see that we saw a rapid rise in prices. So if we just have a look on the table on the right hand side, you can see the summer and winter 22 contracts and how they've moved over a 1, 6 and 12-month period. Now, the 1 month increases that you can see there, particularly summer 22, don't particularly look large compared to the 12-month, but you can still see rises in excess of 150%. That means prices have over doubled within the space of a month, which is quite considerable. If you look at the 12-month and particularly that gas summer 22 12-month, you can see over the past 12 months, there's been an increase of 1,137%, which is quite phenomenal, to say the least. Just looking at the summer 22 contracts again, just in a little bit of a different view. This is looking at it from sort of monthly price ranges over the past 5 years. So how much those prices have traded on a monthly level between the sort of minimum and maximum prices. And you can see that the sort of average over that April 2012 to March 2021 period was about just shy of £4 a megawatt hour on electricity and just shy of 6 pence per therm on gas for any given month. So that's a relatively restricted amount of volatility. When you get to the sort of back end of the curve there in the sort of last 6 months, you can see the rapid increase. And that really reaches a peak when you look at the March 22 contract. Considering we're less than 2 weeks into March already, that summer 22 gas price has traded within a range of just shy of 400 pence per therm already, which is an extortionate amount. Next, if you look at the sort of forward contracts as well, so further along the curve, is this starting to see impacts there as well? Well, yes, it is. You can see from both of these graphs here, these look at each of the subsequent years as averages of the winter and summer contracts respectively. And you can see that each of those years are starting to rise on both electricity and gas. More so on gas. Gas is feeling the impact of this much greater than electricity. But what you can see there is a high level of backwardation. What it means is that current prices along the near curve trade at a premium to future dated contracts. And that's seen by that sort of near-term contract line being at a much higher price. Now, a lot of the impact that we're seeing from this Russia-Ukraine situation is relatively short-term, and it's feeding more so into the front seasonal contracts. That's summer 22, winter 22, and potentially summer 23 as well. They're really feeling the brunt of this. So clients will be seeing the impact of this mainly over the next 12 to 18 months, but that's not to say that this won't be impacting the longer term contracts as well. So if we just take a step back and have a look at the UK energy overview, so where do we get all of our power from in the UK, and more so where does our gas come from as well? Looking at this chart on the top right hand side here, you can see there's a blue section at the top. This is looking at our nuclear baseload. It typically makes up about 15 to 20% of our power generation supply stack. It's a relatively steady baseload, and in fact the actual volume there stays static pretty much day on day. So that's a good baseload that we get there. Moving down one, you can see this sort of dark grey section here. This is looking at our coal. Historically, we had quite a reliance on coal. It was sort of 30 to 40% of our generation stack was made up of coal. As we go forward into the past sort of 5 years, we've really had that sort of drive to move away from fossil fuels, particularly coal as part of our generation stack, as that moved towards net zero. And particularly in the last 3 years there, you can see there's been very limited use of coal. We've actually gone through sort of numerous periods of prolonged coal-free generation. If we just look at the bottom of this though, on the complete other side of the scale, you can see here the increase that we've seen of renewable technology in the mix as well. So this is wind and solar predominantly, and that's been increasing year on year as a percentage of our supply stack. 2021 is the first year that we've seen where the percentage of supply from wind and solar has actually dropped. It's actually been less. That was during last 2021, we had quite a low wind generation, which really affected that power generation that we had. So when we have a deficit of renewable technology, because the wind doesn't always blow and the sun doesn't always shine, where do we make up that deficit? And that deficit is made up through gas. So gas makes up roughly 40 to 50% of our supply stack. When we have those periods where we don't have the renewable output, then we need more gas to feed into the system. So 2021 was the perfect storm whereby there was low renewable generation, there was a lack of gas in and across the UK and Europe as well, which just meant that restriction of supply, but that increase in demand off the back of COVID just meant prices started moving up quite rapidly. If you look at our gas supply and where we actually source our gas supply, you can see this graph at the bottom. So the majority of our gas in the UK comes from Norwegian plants. You can see this here in the red section, also in the green section as well, which is from the UK continental shelf. So that's all around the British Isles. And finally, the yellow section there is looking at LNG imports. That's that liquid natural gas that goes worldwide markets, predominantly from the US. We get a lot of our LNG from, and that's the one that's the real sort of price volatility in all of this. Norwegian supply is relatively stable, as is the UK continental shelf, so it doesn't really feed into the impact of price too much. It's more that LNG market that's a very liquid market. The little grey sections you can see at the top there, they are looking at the interconnectivity between ourselves and Europe. We are obviously connected through pipelines to the rest of Europe, which is why there is a correlation between how European markets move and how the UK market moves as well. And then there's a little bit of storage on there as well. The big question that we've heard recently is do we source a lot of our gas from Russia? Now, in the UK, it's roughly about 5% of our gas comes directly from Russia. In Europe itself, it's a much higher figure. Take Germany, for example, and about 60% of its total gas consumption comes directly from Russian pipelines, which is a very different story. Just looking at that interconnectivity, I've just put two graphs on here just to kind of demonstrate how we are connected to the rest of Europe. So on the left-hand side, you can see that power interconnectivity. These are pipelines that sort of connect us to mainly sort of Netherlands, France, also across to Norway as well. And then on the right-hand side is not all the gas pipelines, but it gives us some of the main ones, particularly the ones from Russia. And these are the pipelines that run into mainland Europe. Three main ones being Nord Stream 1, this one that you can see at the top, the Yamal pipeline that runs through Poland and into Germany, and then this other one that runs directly through the middle of Ukraine. You can also see on there this Nord Stream 2, so that's a projected pipeline that has been in construction over the past few years. It actually got completed in September of last year, but it is yet to get going and get live. There was issues around sort of final certification to get that signed off. That pushed it back until 2022. It then got pushed back until sort of mid-2022, and Magnus will go into it later, but it's potentially looking like that might not go ahead anymore. Now, that was a big concern because it was sort of a concern that people were thinking it was going to be a political weapon to divert gas into mainland Europe instead of passing it through Ukraine. And that was the start of the geopolitical tension that we had. So just looking at those EU gas imports and where does the EU source their gas from? Now, the green section at the bottom here, you can see is those three main pipelines from Russia, the three that I just talked through then. And that roughly makes up sort of 40 to 50% of European gas. Particularly in sort of previous years, you can see it made up quite a substantial amount. Over sort of winter 2021, so the Q4 last year and Q1 this year, we've actually seen a lot less of that Russian gas coming through, which has been feeding into that price a little bit as well. We've also got quite a portion that comes from Norway, that red section. Again, that's that Norwegian supply that we also get into the UK. And again, that's why we're quite heavily correlated with European markets. If the European requires more Norwegian gas, the prices will start to rise as well because there's sort of an excess demand for it. And then the top two sections you can see in the grey, that's looking at LNG supply as well, both the UK and continental together. Throughout 2021, you can see those levels being relatively low, but certainly Q1 this year, that has increased substantially. So even though Russian exports have decreased, we've seen an increase in the LNG, which kind of offsets the impacts so far. Looking at those LNG markets, and this is just a general kind of information slide here, just to give you a bit more sort of detail there. You can see that European LNG imports, we sort of import about 80 million tons of LNG into Europe in any given year. If we look over the Japanese and Chinese market, they both independently source about the same amount of LNG. So when we start talking about this LNG price competition between the two main markets, you've got the Northeast Asian market, which sort of encompasses Japan, China, Korea, etc. And then you've got the European and UK market, which again is where we are over this side. In terms of exporters, the three main exporters are Australia, Qatar, and the United States. So when we start having that price competition, when you start getting either the Northeast Asian market trading at a premium, for exporters such as Australia, it makes much more sense both financially and logistically to get that export straight up to meet the demand of Northeast Asia rather than shipping it worldwide to get it over here. So just looking at that LNG volume that we've been seeing in Europe over the past few years, You can see that there's a general seasonality anyway, that in the summertime there's less demand for gas, so you tend to get a bit of a drop off anyway, and in the wintertime it tends to be a little bit higher. 2021 was notably low though, and you can see that we didn't have as much LNG coming across. That was exacerbated obviously with the sort of gas shortage that we had across Europe and the UK anyway, and that's why we saw a lot of those gas prices start to rise. Q1 2022 has been very much a different picture, and you can see there that the January levels are extremely high. I think they were some of the highest ones we've had on records in terms of volumes, and that's continued, not quite as much as January, but over the past couple of months we've got a healthy LNG supply coming across at the minute. On the right hand side here, it's just looking at a quick price overview of that, the Northeast Asian markets, the JKM market, and then the UK and European markets. So the MBP is UK, TTF is the European market. So UK and European markets trade pretty much as a one-to-one correlation. They're very strongly correlated, and in fact you can't really see the green line on there because it is overlaid by the yellow line. But the big thing that you can see is when we have deviation between the two prices, so between the European price and that Northeast Asian price, that's when we really start to see the impact of volumes coming to either the Asian market or to the UK market. Start of January 2021, you can see the Northeast Asian market traded at a significant premium to the European market. That's because they had quite a cold spell that caught them off guard. Their storage levels or their stock levels were quite low, particularly in Japan and China. So they increased their demand for that, and that's why price competition started. That's where their price started to rocket quite rapidly, and a lot of that LNG started heading over that way. Since then, throughout 2021, you can see that the Northeast Asian market was trading at a slight premium throughout that period, again just keeping a lot of that supply heading over eastwards as opposed to the European market. And then since then, throughout sort of winter 2021, it's been very much a price competition between the two markets, and we've had kind of fluctuations as to who's been trading at a premium. That period just before Christmas, you can see that the European and UK market took a bit of a premium to the Northeast Asian market, and as a result in January you can see we had a lot of LNG scheduled and actually coming across to be delivered to the UK and European market. We're now at a stage where obviously since the invasion of Ukraine has taken off and we're starting to take a stance on Russian gas and trying to move away from that Russian gas, we need to find alternative sources of that gas. So the first and foremost way of doing that is straight through LNG. So if we can increase our LNG imports to offset that Russian gas that we're trying to see, and that's where you can really see a hike in price of those European and UK markets. It's trading now at quite a significant premium, and you'd expect over the coming weeks and months that we should see more LNG starting to come across to Europe. What I can do here as well is, if we just take another view of this price development, is the longer term view as well. So this is the forward curve. This isn't a price prediction of where that price will go. This is the current forward curve and how that market is trading right now. And you can see the impact of that price rise. The price rise right now, obviously off the back of increased demand, takes us up quite significantly. And that feeds into the next sort of year of pricing. It takes a bit of a delayed effect, but then in years 2 and 3 onwards, there is a much more lesser effect of that price. And that's what we're seeing with that backwardation that we were talking about before in gas and electricity markets over in the UK. The impact of all this increased demand in the short term affects the next sort of 12 to 18 months, and then thereafter it still has a lasting effect, but to a much more dampened magnitude. So just looking at those Russian flows, like I said, there was 3 main pipelines that came across. That was the Nord Stream 1 pipeline, so that's all this yellow volume that you can see here. You've got the Yamal pipeline that runs straight through Poland and into mainland Germany. That's all this red section. And then finally, you've got this sort of Ukraine pipeline as well, and that's this green section. Now, Nord Stream 1 has continued pretty consistently throughout the past sort of several years. And even throughout this sort of geopolitical tension that we've seen over the past few months, that has maintained its output. The Yamal pipeline, which is this red section over here, we've really started to come into some issues there, particularly in Q1 this year. So there's a prolonged period of time through January and February where that pipeline was actually being, flows were going eastbound. So that means it was going away from Europe and towards Russia, which is very much against where it should be going. It should be heading westbound, that flow. And that was really starting to feed into the market and start keeping the market buoyed particularly. And then finally, that Ukraine pipeline, you can see there was a bit of a drop off when we got into COVID, and since then it's never really recovered. We did have a bit of a drop through sort of January and February, but nonetheless, if you look at Russian exports as a whole, they have been increasing over the past 3 months. Take that on a year-by-year basis, and you can see here each of the subsequent years, what have those Russian exports been looking like? Well, 2019 is much higher, that's for obvious reasons. You can kind of take that in isolation, that was pre-COVID. Once you get into COVID sort of years, so 2020 and 2021, you can see that it's been relatively similar, particularly through the first half of both of those years. We had a pretty similar export from Russia. 2020 it did start to increase at the back end of the year, whereas 2021 we've seen it tailing off slightly. The main reason for that in the back end of 2021 was due to the gas shortage across Europe. Russia were intent on making sure they were replenishing their own stocks first before they were exporting out to Europe. So that's why we started to see that decline. And as we come into 2022, you can see those levels are still quite a bit lower than previous years. Nonetheless, each month the flows that we're seeing from there have started to increase. Now, the final bullet point you can see on here is around that latest developments there. And what Russia have said is if the West looks to embargo Russian oil exports, then they are threatening to turn off the taps. Now, that is the big concern, and that's why we're really seeing an uptick in prices for gas and power prices. It's not really running too much off the fundamental picture just yet. It's running more off the risk that's being built into markets, the risk of those taps being turned off and us having an extreme gas shortage over the next few months and years potentially. So if we just have a look at the actual fundamentals themselves, aside from the Russia-Ukraine situation, what is gas demand looking like in Northwest Europe and the UK? Well, if you look at the UK on the right-hand side, you can see that general seasonality that occurs. Obviously, there's less gas demand during the summer months, more in the winter months. But currently in 2022, our gas demand is actually lower than previous years. So you can't put this price rise down to an increase in demand in the UK. If you look at the Northwest European market, again, you've got that seasonality where it drops off in the summertime, but we're largely in line with previous years in terms of that gas demand. It's potentially ticked up slightly in March. I don't know if that's potentially feeding into the market a little bit. There's sort of extrapolation of that line might just take us to sort of multi-year highs, but currently there's no excess of demand that is required right now. In terms of the European gas supply, this is the other side of the picture. So typically you get a price rise when there's either an increase in demand that outweighs supply, or there's a restriction in supply that it then falls much lower than demand levels. But if we look at supply levels, they are relatively in line with previous years. Again, 2019 can be taken in isolation. That's pre-COVID. There is less demand since we've had COVID. You get the general seasonality anyway, but in the summertime you don't need as much. But you can see that over the past quarter or the past 6 months, that supply level has still been relatively healthy. You can see the Norwegian stuff at the bottom, so the Norwegian imports that we have, again, relatively steady throughout this whole period. The LNG picture in the sort of pinky colour that you can see, that has been increasing over the back end of winter and that has been particularly healthy in Q1 this year. And then all of the other sort of elements that we've got in there still remain relatively healthy. The grey section that you can see is that Russian gas flows. And although we've seen a bit of a decrease in the Russian gas flows for the first 3 months of this year, that's to date been relatively offset with that increased LNG. So it's not had too much of an impact in our overall gas supply within Europe. And finally, just on this sort of gas supply picture, it was a big story throughout 2021, was around storage levels in Europe and the UK. And is that still a concern that's sort of feeding on? Well, if we look at the UK first on the right-hand side, throughout 2021, this red line, you can see that particularly through the summer months, we were sitting at multi-year lows in terms of our gas storage level. And that was off the back of, like I said, that cold spell that we had in sort of early April, and then that lack of LNG, the ongoing maintenance that we had, and just the lack of general gas that we had to inject back into our storage. August, we had a very good month, and we managed to get back up in line with previous years. And as we come into 2022, we're actually now sitting at multi-year highs in terms of our gas storage levels. But like I said earlier on, that interconnectivity that we've got between the UK and Europe means that we can't just look at the UK market in isolation. We've got to consider the European market. So the European market on the left-hand side here, you can see throughout 2021, again, we were at multi-year lows, same sort of situation that we had And then as we come into 2022, we've only recently taken over, I think it's the 2018 level, and we're now not sitting yet at multi-year lows, but we're near the bottom of that sort of 5-year average. And the big concern here is if those Russian taps go off, are we going to be able to inject back into that storage quite as quick as we would have done previously? Ideally, the more that we have in storage, the less concern that is fed into the market, and the more prices can be a more realistic level as opposed to be buoyed in the market. So I'm going to hand over to Magnus now, and he'll just go through a little bit around kind of the response from the UK and Europe.
Thanks, Dave. So as Dave says, it's not just a UK or a European, it's an international problem. So the International Energy Authority have come up in the last couple of weeks with a 10-point plan to move us away from this reliance on the piped gas. And I'm not going to go through each of these in detail, but this has been the sort of the starting point that the EU have taken to look at how can they themselves divert their usage from Russian gas elsewhere. And one of the big things is to try and get, as Dave says, more LNG. So Germany imports about 150 billion cubic meters of gas every year from Russia, together predominantly Germany, but the rest of Europe as well. And their plans are to try and get a third of that from LNG this year alone. So the huge spike that Dave showed in summer is a reflection of the fact that the whole of Europe is scrambling to get gas from alternative sources. In the longer term, they intend to try and be away from any reliance on Russia by the end of the decade. But it is a long-term plan. And as Dave's shown, with the gas that is coming through Nord Stream 1 and through Ukraine still running, they don't want to be in a position where those are turned off. So whilst the US sanctioned oil and gas yesterday, and the UK said that they would not be using any Russian oil and gas by the end of the year, Europe can't do that. It cannot take that chance. So they are looking at alternative ways of reducing their gas consumption whilst hoping that Russia still delivers. The Nord Stream 2 pipeline, as Dave said, was built. It was ready to go. It should have been delivering probably Q2, Q3 this year, but it has been completely stopped. It is not a reliable source, as they put out there on their strap line, and in fact the staff working in their Swiss office have been laid off, and the German utility Uniper has written off their €1 billion investment in the pipeline. Whether we'll ever see that working is debatable. Some talk about 2024, 25, but a lot is going to depend obviously on how the next year or two go. The other big point that the EU and particularly Germany are going to work on is diverting gas for power generation. It's likely that the German nuclear plants, which are due to be closed at the end of this year, may be kept open, and also there's going to be more fossil fuel generation. The lignite and coal production across Europe is not going to start ramping down anytime soon. So it's going to be a case of holding on for the next year or two, and that's reflected in the markets. We've seen coal prices spiking up in the last 2 or 3 months in anticipation of more fossil fuel generation. And if we move on from this to the next point, Dave, please, next slide. So what does this actually mean for buyers in terms of their annual costs? Dave's put together an example for electricity and gas using a 10 gigawatt hour client, and you can see for electricity, if they bought it last year and if they bought the same volume this year, it's more than doubled in price. But for gas, it's just astronomical increases. So it's gone up 5-fold in the same period of time. Now, every client's going to be different, but we've just taken a rough number here just to give you a feel for what things are looking like. So what can you actually do to reduce, first of all, your gas consumption? Make sure that you're keeping an eye on what's going on and be prepared. I think most energy managers will see these things and just look, yep, looking at all these things, but it is just purely as a reminder to all of you, make sure that you are keeping an eye on everything that you possibly can. When we're managing positions for clients, we need to know your latest information. We can only buy against what you tell us you're going to need. And if you can reduce your consumption, you know you can make efficiencies. Even in the short term, you will be saving huge amounts of money given where the markets are at the moment. Longer term, please start looking at all those energy efficiency programs. Start looking at alternative generation sources. I think it's going to be such an important area, and I don't think this is going to change anytime soon. As Dave pointed out, forward prices do look as though they're coming off, but it is a very changeable market, and we could find ourselves in 6-9 months time with those high prices continuing for another 6 months or more. Okay, the last point before we get on to any questions, we've had inquiries about Gazprom, given that they're a Russian backed supplier in the UK. We just wanted to tell you what we know. We know that they're still a licensed supplier. They are still operating. They are still making sure that people are getting their gas delivered, and clients are still under contract with them. So please be aware that if there's anything that you're thinking about precipitously because they're a Russian company and you feel you want to consider alternatives, please talk to us first before you do anything. As for other suppliers, clearly a lot of suppliers are under pressure at the moment because of the high prices and the fact that they are having to make provisions to cover market movements and everything else. We are not aware of any suppliers who are having any difficulties, and any suppliers that are going through changes in terms of their operations, what they can offer us in terms of services and products and everything else. We will endeavor to keep clients appraised of those. But again, keep in touch with us because it's changing week by week at the moment. And I think that's about it.
And just before we go on to questions, I'm going to try and quickly summarize what we've been through there. It is as short as sort of 2 sentences as I can. In terms of that current fundamental picture, what we're seeing is demand has not been increasing across the UK and Europe. It has obviously off the back of COVID, but it's not increasing exponentially in terms of previous years. And the supply level is currently healthy. So although there is a lot of concern about the what if scenarios and what might happen going forward, right now we have sort of a healthy supply. So the way that the markets are moving at the minute isn't off the back of sort of current fundamentals. It's very much that price risk in reaction to the Russia-Ukraine invasion and what is going to be happening going forward. And that's a very volatile situation because a lot of things change on a very rapid basis. You'll have seen governments coming out over the past 2 weeks changing how they're looking at sort of moving away from Russian gas dependency, and that's going to be a continually changing situation. I think the key message to take away from this is it's very hard to say where price is going to be in a month's time or even 6 months' time. It's a very fast-moving situation, and you can't really say if that's going to be increasing or decreasing. What you tend to get is when you get a sharp rise in prices, once things settle and there's a bit more understanding about the longer-term picture, markets tend to retract a lot of that sharp upside. Not saying they'll be back down to where they were in previous years, but they should certainly retract some of that immediate price spike that we've seen. That being said, when people are looking at their renewals and their forward sort of hedging strategy, what you really need to consider and what you really need to do as clients is take it away and understand your risk appetite individually. If you're very risk averse and you can't swallow any more of the upside, then I would really consider looking at some of those contracts. It's key right now that you understand it's likely going to get worse before it gets better. That volatility over the next few weeks will be extreme, and it really needs to be a decision as to how much your business can sort of take before it proves harmful. That being said, if you have much more of a risk appetite, if you've got a higher risk appetite, then potentially holding off for a little bit may prove beneficial. But like I say, it's a very unknown situation at this moment in time. I'll hand over to James for some questions.
Yeah, thanks guys. As we said, please put any questions that you have into the chat box. They are coming through. They are being passed to me, so I will put them to the guys. Just a quick observation first, Dave. It sounds like clients or organizations that have already taken a long-term view in the past would have been much more protected from this. And I know we've seen a lot of organizations looking to buy in a flexible manner recently, having been more used to fixed price procurement in the hope that they don't get stuck at the top of the market, and that has potentially opened up some of those organizations to more volatility that they haven't been used to. So from an observational point of view, it seems to me that if you are going to take a flexible hedging based approach, the trading window before that first point of delivery is fundamental, without which you really expose oneself to these movements in the short term that cannot necessarily be mitigated as people might think. So just having that forward view to have at least a position in markets 1, 2, 3, 4 years ahead really softens the impact of these kinds of erroneous events. I just thought I'd make that point. Second, my first question really, Dave, is what you just suggested here is that the fundamentals are not giving any particular reason for prices to be where they are today. We understand these extreme events that have got us to this point, but, and this might be for Magnus as well, how does the speculation in the commodity markets, and we talk a lot about people panicking given those events, how does that directly impact on these prices that genuine buyers of gas and power then have to stomach themselves? Can you explain that dynamic?
So the market price will very much move off the back of actual supply and demand. And when you have people taking, or the risk being built into markets and people assuming there's going to be sort of Russian gas taps turned off, etc., you'll get people buying their positions. People will close their position off, whether that's fixed contracts or flex contracts. That buying power then increases perceived demand, and that increases the price. So as price starts to rise even more people buy in, that sort of exacerbates the situation. What you can then tend to get on the sort of counter side of that, so when the markets reach a point that traders will then say, oh, I'll sell a position and I'll take the profit from that, or whatever, then you get the sort of counter movement, and that looks like there is a lack of demand, and the market may then change as more people start to sell off their position or sell part of their position for any given period in time. You will then get the counter movement in markets. I don't know if you want to add to that, Magnus.
Just to say, yeah, I think the markets are in panic mode at the moment, and the spreads, as Dave showed, are just gapping incredibly. So to support what you said, James, the longer the clients allow the trading team to buy, the less need there is to be involved in these markets.
Yeah, makes sense. Another question. Can you just tell us where you get your data from, how live it is, where you're making these decisions based on?
Yep, so we've got a Reuters license. Reuters, or is now called Refinitiv. They feed from trader screens. We get live prices coming through, and we've got screen prices for all the contracts. It's also a source of information there across all supply and demand data, consumption data for different countries as well, analysis pieces in there as well. So we're getting a live stream of this data that we can keep an eye on.
And I was just going to say, those live prices are the wholesale prices that all the utilities trade amongst themselves. So we provide those prices without any premium whatsoever.
Right, so we can see the actual live screen prices. However, when we are buying energy from a particular supplier, we're reliant on their trading desks mirroring those prices or getting as close to those prices as possible. Have those suppliers still been operating business as usual, as efficiently as they normally would?
On the whole, I suppose if you're looking at fixed contracting, a lot of suppliers have actually been sort of closing their trading books. They've not been offering fixed prices at all. The levels of volatility mean that they can't provide a price, or if they can provide a price, they can't hold it for a period of time. Fixed pricing always has to be closed off within day, or usually has to be closed off within day, but they're pulling prices within a matter of 20 minutes or so. On the flexible side of things, the majority of suppliers have managed to stay open. The fast moving markets that we've seen means holding a price is quite hard, and actually obtaining that price is also difficult. We've had a couple of suppliers that have actually closed their trading desks for a day or 2 days due to the level of volatility.
Right. Okay, and so we're seeing a lot of out of contract rate movement as well. So when clients are out of contract, can you just talk around how that might compare to market levels and how we're seeing different suppliers react differently to that, mostly for fixed price clients?
Yeah. Out of contract rates are usually very high, particularly in comparison to the contracted equivalents. What we've seen is suppliers revising those out of contract rates, particularly over the past few months since markets have gone so extreme. And those out of contract rates are absolutely phenomenal. You want to be avoiding that wherever possible. Even if it means getting in a short-term fixed contract with the current market prices, you'll more often than not be better off than sort of riding the wave on out of contract rates.
Okay, we've got a question here from Philip, which is around purchasing 100% renewable electricity. What's the implication on prices from these sources?
So if you're referring to sort of Rego-backed energy, so the Rego market also has been in a bit of turmoil recently, where sort of a couple of years ago you'd see Rego certificates for as low as 35 pence per megawatt hour or 60 pence per megawatt hour. We've seen those massively increase into in excess of £7 a megawatt hour, so a huge increase there. If you have fixed in your Rego price as part of your contract, most suppliers should be able to continue providing that. We have had a couple of suppliers that have invoked clauses that allow them to pull out of that and say, sorry, we can't offer that any longer. So yeah, it's a very fast moving market at the minute.
Okay, thanks, Dave. Another question here from Tracy. We're in fixed price contracts through to September 2023. Is there any possibility of suppliers looking to alter the rates within those contracts?
First, I'd say well done for getting in contract till September 2023. That's you're managing to mitigate a lot of this. In terms of suppliers changing the rates there, we have seen a couple of suppliers over the past few months that have looked to change fixed contracting rates. They try to invoke clauses. I'd recommend that you certainly read through your T's and C's, potentially even get your legal team to look through those T's and C's as well to see if there is any conditions that can invoke that. Realistically, suppliers should have backed off their position, so there shouldn't be any issue there of suppliers pulling prices or revising prices. However, suppliers are quite under a lot of pressure at the minute, so you certainly can't rule it out. The other sort of risk, I suppose, is around suppliers going under. We saw quite a bit of that last year, and if that is the case, then it goes to the supplier of last resort kind of methodology, whereby you could be re-exposed to the market. But yeah, I'd certainly recommend your legal team just reading through your T's and C's and making sure.
Just one other question here. So from a relationship point of view, obviously we've got relationships that go back a long way with some of these suppliers. How can that help various organizations to manage this situation and to potentially get the best out of suppliers? Is there anything that we can do here to try and protect clients from things like what we just described with contracts or rates being changed mid-term? Is there anything we can be doing here to get ahead of the game to avoid anything that's unexpected that may impact budgets that have been preset for 2022?
Do you want to take that one, Magnus?
Yeah, I think keeping in touch with us as much as possible so that we can work with clients to understand what their issues might be certainly helps. We are talking to all the suppliers and keeping in touch with how they're coping with things and asking them, as Dave says, what areas are causing them concern so that we can be prepared for any changes on their services and such like. We are always looking at alternative flexible solutions to make sure that we are managing them as best we can. So it's a constant dialogue with the suppliers.
Okay, great. I think that's pretty much all the questions that are coming through. Unless there's anything else, please take the last couple of minutes to ask anything. I just wanted to re-emphasize the point about Gazprom. We've also had questions in relation to Total is another supplier that have investments in Russia. You would have seen on the news that BP and Shell have pulled out of their investments directly into oil infrastructure. Total, so far, French company, have not done the same thing, at least not yet. So there is a question as to, from a moral point of view, what organizations want to do if they have commercial relationships with these companies. But just be aware that as UK registered companies, while they do have connections to parent companies that are Russian, these entities are not sanctioned by the UK government yet, and we're not sure that they will be. So the message really is, there is nothing currently to trigger a mid-term transfer away from these entities. What you could consider doing, however, particularly if it's companies just with an association with Russia, i.e. not Gazprom, is we could look to put pressure on those companies now around renewals. So what will be fed up the chain, for example, if you're with Total, is that we're uncomfortable with your investments in Russian oil and gas infrastructure. We will likely consider our options at renewal, whether to look elsewhere. However, that's not implying that we're going to cancel any contracts anytime soon. And that will help to put that lobbying pressure onto the management structures within those organizations so that they do start to take these issues seriously. We've seen a huge response from Western organizations, governments, all sorts of groups in relation to what's happened in Ukraine, which is 100% right. And so just consider how you may feed into that in the medium term. But please talk to us before you initiate any of those discussions with suppliers, or consider not paying any bills. That could lead to some quite severe action the other way, given that the likes of Gazprom and other suppliers will be facing a huge bombardment of activity from their customers. And we just want to make sure that we plan it logically for you before we do anything drastic. So if anybody's got any questions or want to contact us direct after this, you've got some contact details there for myself and for Corinne. Our trading and risk team are obviously very busy, but are very available to our clients anytime. So please pick up the phone if you have other concerns. Thank you very much for joining this morning. We will distribute some of this material to people afterwards. And if things change dramatically over the coming weeks, we'll of course hold another session like this for you to join in. So thanks again, and I think we can end it 5 minutes early.